Good afternoon, everyone. I'm Candice Hickmott and I'm the Developer Regional Sales Manager in WA, SA and TAS for realestate.com.au. And I'm joining you from my home office in Perth. It's my absolute pleasure to welcome you to our webinar today. As we adapt to new ways of working, realestate.com.au have introduced a webinar series to ensure that you are best supported through COVID-19 with the latest news, data and market insights to assist you in navigating through these unpredictable times. Today, you'll hear from REA Group's Chief Economist, Nerida Conisbee. Nerida will provide an update on the off-the-plan property market as it stands amid COVID-19 and followed by a Q&A session after that. I'll now hand you over to Nerida, who's joining us from Sydney. Thanks, Nerida.
Thanks, Candice, and thanks everyone for dialing in. It's so good to have you all here today. So today I'm just going to talk a little bit about the economy. Obviously, probably less to report on a policy perspective than what I did last month, but certainly lots of changes that have taken place over the past 4 weeks. And then just talk through some data in terms of what we're seeing more generally in the market, and then going into a lot more detail into some suburbs, some new developments that are attracting attention, buyer types that we're seeing particularly active at the moment. So I'm going to just share my presentation and hopefully this works, because I don't think it worked very well last time. Yeah, that seems to be up. And just starting with how different conditions are from last month. So I guess the first one is that the number of new virus infections has dropped dramatically. So we certainly aren't out of the woods at all. If you have a look at how many infections are taking place, I mean, so what happened in Victoria over the last few days with the meat manufacturing really showed how quickly things can flare up. But it is looking very different in terms of new cases compared to where we were a month ago. It is leading to gradual easing of restrictions. So this is really, really good news. It's in that more of us can get back to work in the way that we used to. It is the start of a recovery once we start easing restrictions. And it is coupled with all this stimulus that has been injected into the Australian economy. So 16.4% worth of GDP. It is 4 times more than what was spent in the global financial crisis. So huge amounts of money. We do still have a solid banking system. We haven't seen any distress in our banking system or in our finance system. So that's very, very good news. Very good news for property, because what we are seeing is quite different conditions to what we were seeing in the global financial crisis, and even in previous downturns where property did take a hit pretty quickly. For property more broadly, New South Wales did announce a return of live auctions, open for inspections. Queensland is doing the same. We're not really seeing much in Vic. I know WA is opening up as well. So again, really good news that we can get back to ways of selling that people are familiar with and like. And for the new development industry, those open for inspections are handy if you have a project that it's already completed. But then also the investment that's being undertaken in video inspections. We've certainly seen a huge uptick in video views on realestate.com.au. So people are getting more and more used to video inspections and digital inspections and the like. While we are going to be able to start to get back to work quickly, it will take some time for the economy to recover. So easing up of restrictions is great news, and more cafes and restaurants eventually opening, gyms reopening will be good news, but it will take a lot of time for us to get our confidence back, and that's not just consumer confidence, it's also business confidence, and there will be some structural changes that occur. So certainly the tourism industry has dramatically changed at the most extreme, but also importantly for property, the education sector, particularly foreign students, will take a little while to return and may not return the same way. They may, we don't really know, but there will be some really big changes to the way that our economy operates, at least in the short term and quite potentially in the longer term as well. In terms of what we've seen with the rental market, it has been quite interesting because it was the market that was hit first. We did see quite a rapid increase in listings very, very quickly as a result of COVID-19, as people moved back home or went into share accommodation. or even didn't come back to their homes if they were foreign students, for example. And as a result, we did see this quite rapid rise in rental listings. On the back of that, we did see renters more likely to be exposed to job loss as well. So there was really a double hit that took place in the rental market. It is surprising, advertised rents haven't declined since the lockdown as much as I would have thought. I would have thought that we would have seen quite a significant decline in rents. But I think what is happening is that advertised rents aren't really reflecting the true nature of what rents are doing at the moment. So if you have a look at where negotiating is taking place, it's probably, oh no, it's not probably, but it is taking place within people's leases. So people that are already signed up with the landlord would be negotiating their rents, whether they have lost their jobs or seen a wage cut, or even if they just see an opportunity now to negotiate a rent. Or it could also be done prior to signing. So a property that's advertised on our site, for example, for $1,000 a week, may end up only, the landlord may end up getting, $950 per week because negotiating is going on behind the scenes. So that doesn't get updated on our site. It is a tenants market, so I've never seen it be such a tenants market in my whole career. We've seen pockets of it, obviously, around Australia, but across the board to this extent just hasn't been to this level. You can see the two areas that are a bit of a standout. I mentioned Canberra last month, and again, pretty much all of our data points, Canberra does show very different behaviour to the rest of Australia. So pretty much on the back of all that government employment, a lot more confidence in that market. And then Perth, which last month I did mention Perth as being a potential market to do well out of this, but we weren't yet seeing any data to suggest, but now we are on rental data that Perth rents actually have increased since COVID-19. So the mining sector is doing very well at the moment, at least very well relatively. I mean, you do have to put into perspective as to how badly other parts of the economy are going. Perth hasn't seen as many infections. They are still being able to run their mines, which is really important. If we have a look around the world, a lot of mines have been shut down because of COVID-19. And then importantly, we don't export oil because the oil price has gone to negative. There's too much oil in the world, but there's not enough iron ore, coal or gold. And as a result, given that 80% of our mineral exports are in those three categories, it has been a positive for the WA economy, and obviously that flows through to Perth. Other end of the scale, Darwin has been going badly for a long time now. We just haven't seen a recovery, so it's gone even worse since COVID-19. It's obviously a very small market. In terms of rental listings, you can see there the types of places that are seeing big upticks in rental listings. So the main one being the Melbourne CBD has seen the biggest uptick in rental listings. It is a big rental market, so I guess you need to put that into consideration. But if you have a look down there, there are the places that have got lots of rental accommodation, somewhere like Melbourne CBD, Sydney CBD, South Bank are good examples there. They are places that also have a lot of foreign students, so Carlton is a good example there, South Bank. And then there's also places that do have a lot of Airbnb accommodation. So Manly and Bondi Beach are both on there, that they do have lots and lots of properties available at the moment. Broadly speaking though, Melbourne CBD, Sydney CBD have seen the biggest increase in rental listings. In terms of furnished rental listings, it is Queensland, so off the back of that very big tourism market. It is likely that the areas that we'll see the biggest drops in rents will be those areas that have a lot of new development and very similar types of accommodation. So it is easier to negotiate in an apartment building. If the apartment building does have, say, 20 vacancies, it is easier for tenants to negotiate to move to another one of those apartments if the apartments are very similar and it is very simple to move. So I think that's one of the risk areas, that those high development areas where there is a lot of investment grade stock, they'll be the areas that see the biggest drops in rental rates. Rental search has recovered, and you can see there that we did see this big drop in terms of what happened to search activity on realestate.com.au. It has picked up, and you can see there that quite a significant bounce back. It dropped back a little bit last week, but it is likely that many renters are looking for deals. You know, I think when you have a look at what renters are doing at the moment, you do have those that are financially distressed and, you know, really do need a lot of protection, but there are also a lot of renters that are just, you know, seeing now as an opportunity and looking out for better deals, and also looking to negotiate with their landlords more so than they in a situation that they've never been able to do before. There are a few things helping renters: the 6-month ban on evictions, the various state government stimulus packages. Some state governments are giving cash to affected renters, some aren't. But I think overall what we will find is that the relaxation of restrictions will help many renters get back to work, and that will really help landlords and help the property market more broadly. Buyer activity has bounced back a lot, and you know, this is something that I didn't expect it to get to that level so quickly. So you can see there the declines that we were seeing pretty much following the lockdown in mid-March. So we saw this horrendous decline in search, and it toppled down for quite a few weeks. But what's been happening is that pretty much since the third stimulus package was announced, we did start to see a stabilisation in search, and then we've just seen it really pick up since then. So I think it is partly because of the stimulus packages. It is partly because the banking system is pretty good. So if you've got a job at the moment, you can get very cheap finance, the cheapest finance we've ever been able to get with these incredible declines. We have got this 6-month freeze on mortgage payments, which I think is giving people a little bit more confidence to go out there and buy. And we've also got a lot of people that we think are just looking for bargains. So there has been a lot of media coverage that prices are going to drop by a lot. It doesn't look like that will be the case, given what we're seeing on site. But I think that there is a perception that there may be value, and the types of suburbs that people are looking at really reflect that. So I'll talk about that a little bit later on. I think importantly, what we're seeing with search is now flowing through to inquiry. So high levels of search is great news. You know, it obviously shows that people are interested and feel a little bit more engaged with property than perhaps they did previously. But once we get inquiry up again, that's when we start to show intent. And for the first time for quite some time, or since the COVID lockdowns, we have seen an increase in inquiry on the site. So it is different for new development, and I'll talk about that today in a bit more detail, given I know you guys are all interested in that. In terms of pricing, we didn't see much of a change in April. It was certainly a lot less of a change than I expected. I certainly didn't expect Sydney to creep up a little bit over the past month. So the impact on pricing at a capital city level has been fairly muted. I think you do need to keep into account that we have to calculate pricing based on on-site reporting. So we do rely on agents to report the sales price, and we do rely on that to be able to get a gauge as to what's happening with pricing. There is a challenge with the Valuer General data. So the Valuer General data, which is government data, does become available, but there's generally around a 3-month lag between when the property is sold and when the Valuer General data on that property is released. So we do backdate, and we do backdate our time series. So we won't really know exactly what happened in April, but following from this, from a fairly decent sample of properties that have sold, it does look pretty stable at this stage. So I think it is partly to do with the fact that we do have a lot of people out there searching. We've got a lot of potential buyers, but also we have a very low number of listings. So listings have really tumbled, and so we do have pretty confident buyers, and that's flowing through to inquiry, but we just don't have enough stock. So it is that supply-demand imbalance is really supporting pricing at this stage. Capital city level, you can see they're not much of an impact, but there will be some areas that will be more impacted by others. So I think it will be areas that we do start to see landlord distress, and we do start to see some level of distressed sales. So we're not really seeing any distressed sales at the moment. because of, you know, those factors, the mortgage payment freezes, the stable banking system, the low mortgage rates. But it is possible that there will be higher levels of landlord distress that may lead to some forced sales. First home buyers are really happy at the moment. If you have a look here in inquiry, in terms of what we're seeing from first home buyers, Canberra doubled over April 2020 compared to April 2019, but pretty much up across the board in terms of what's happening with first home buyer inquiry. It does reflect a few things. It reflects that first home buyers don't like fast markets. They do like to transact in slower markets. We've seen that in previous cycles. They also don't like investors. When we see very high level of investor activity, we don't see much activity from first home buyers. They are quite competitive in the way that they look at real estate, and they are being buoyed by some really good incentives, government incentives. So Victoria just extended their regional new development government incentive, which was very well received in many locations. And we have the 5% deposit scheme, which really was a big change, led to a really big change to the market when it was introduced in January. On the other side, you can see their investors are just down everywhere. So there's been a 20% decline in investor inquiry. So investors were just starting to recover. Investor activity was just starting to recover at the start of the year, but it has really taken a dive since conditions have changed. In terms of what first home buyers are inquiring on, they have been looking a lot at units, and you can see there it's not it's actually dominated. The top 10 suburbs are really dominated by the Victorian unit market. So Melbourne CBD may be seeing quite a big uptick in rental vacancies, but it is also seeing quite a strong, or not very strong levels of inquiry from first home buyers. But a lot of very much inner Melbourne areas, St Kilda, South Yarra, Richmond, also Randwick in Sydney, seeing a high level of inquiry. A few house and land locations as well. So you've got Craigieburn, Werribee and Tarneit also hitting the list. So first home buyers are very focused. Obviously the price points are important, but also it does appear that there are some locations that they do prefer. Investors have backed off, but there are some locations that they are still very keen on in terms of inquiry. Surfers Paradise topping the list, followed by Melbourne CBD, followed by Manly. So there's actually quite a few expensive locations that we are seeing investor inquiry coming up. Again, it may be a little bit related to people looking for opportunity and looking for bargains in the market. So, I mean, there's places like Manly, Sydney CBD, Bondi, Byron, you know, they're well over a million, 1.1 million. So they're not typically at the price point that we generally see a lot of investor activity, but at the moment that does seem to be a little bit of a focus. The suburbs that people are looking at in terms of demand. So Medindie popped up, got pushed up by one phenomenally impressive home in that suburb. So when we do these rankings, we do look out for properties that are runaway successes that can sometimes push the suburb up the list. So Medindie is a little bit of a standout, primarily because there was a really beautiful property there still is a very beautiful property that is available in that market. For other locations, you can see there the list of suburbs, very much premium Melbourne and premium Sydney suburbs making the top 10. What's been interesting is that in February and March, we were starting to see cheaper suburbs hit that top 10 list for houses. So we did see Watsonia, for example, get on there. We saw Hornsby. You know, Hornsby is not exactly cheap, but it's certainly not as expensive as somewhere like Bronte. And they've dropped off, and we've got places like Toorak getting back onto the top 10. So Toorak is an interesting one. It is a suburb that does do well during times like this. So we saw also in the last downturn as a result of the Royal Commission that Toorak pushed up to the top 10. So I think it is partly people just looking for bargains in those markets, but also people have a perception, which, you know, rightly so, that when you buy in these premium suburbs, properties do tend to hold value better than buying in some other locations around Australia. In terms of the rental market, not much has really changed here. The types of places we are seeing high levels of rental activity tend to be northern Melbourne, the inner north of Melbourne, Fitzroy North and Northcote. Very high levels of activity in southern Gold Coast, so Burleigh Heads, Palm Beach. Tasmania popping back up there. I haven't seen Tasmania for a while, but Glenorchy came in at number 6. And then elsewhere, South Australia. So South Australia does continue to be the area that we see the highest views per listing from renters, and it hasn't really translated to rental levels. So we actually saw a bit of a decline in rents in Adelaide, but there does seem to be a lot of interest. So it is probably driven by jobs growth and probably government jobs growth, which tends to be a feature of that economy. Overseas buyers, there was a story, I think, in the AFR recently that overseas buyers are back, and I think that this is the case perhaps for some projects that they have been very successfully marketed to overseas buyers, but overwhelmingly what we're finding is that they're certainly not back, and we have seen a very big drop off in terms of activity. Anecdotally, we are hearing a lot of activity in premium parts of Sydney and Melbourne from expats, and perhaps driven a little bit by the fact that Australia has done quite well through this COVID crisis in terms of not having a very high level of infections, but probably also driven by the weak dollar. So it is quite cheap to buy in Australia, and if you are an expat and looking to come back, you may be looking now as an opportunity. Big drop-offs in Chinese search still. So they started to recover at the start of the year, really declined again. New Zealand is generally a growth area, declined. And then even Hong Kong, which has been increasing pretty much consistently since mid last year, have seen quite a significant decline. In terms of inquiry for new developments, we've got some really good really good views data coming through across Australia. So if you have a look at March 2020 to April 2020, we did see a really, really big pickup in the number of people that were looking at properties, new developments on realestate.com.au. It's not the same when it gets to inquiry. So you can see there that pretty much everywhere we've seen a drop off in inquiry. Northern Territory, it is a very small market, so it does tend to fluctuate a lot. So probably best to ignore that one. I think what's interesting though is WA. So the WA development industry has been tough for a long time, but we actually saw a stabilisation of views. A stabilisation of leads. It was actually the best performing market in terms of leads, or in terms of changing leads that we've seen across Australia. But everywhere else you can see those big declines. Even Canberra, which is still very, very solid in terms of all other activity that we're seeing on site. In terms of the projects that people are looking at, it is very much, you can see there that the types of projects people are looking at are largely beautiful new apartments in great locations, so that there does seem to be probably a little bit of dreaming taking place. But when we have a look at leads, so when we start to look at people showing a little bit more intent in terms of looking to buy, you can see there how it's dominated by house and land projects. So 518 coming in at number 1 in Edmondson Park, but pretty much dominated by house and land projects. So this then really comes back to who's buying at the moment. First home buyers are very active. We can see it broadly through inquiry. It is very good news for the house and land sector. If you have a look on that list, we're not really seeing many large-scale projects popping up. Nothing much, or not much, that is really targeted to investors. But luxury projects are very popular, and so I think in terms of when we look at the apartment projects that people seem to be liking at the moment, it are things that are attractive to owner occupiers, and also tend to be a little bit niche and in locations that people really want to be in at the moment. So it's quite a different market because of those low levels of investment activity. When we have a look at offshore property seekers, again, you can see there how popular luxury projects are with them. So I think this is when we're seeing coverage about, say, Chinese buyers coming back. I think the weak Australian dollar may be driving a lot of this activity. That if on one hand you've got a slow residential market in Australia, so people potentially doing better deals, but also if you've got such a weak Australian dollar that buying somewhere like King and Phillip, which is a beautiful project, you can potentially get it at a better price just because of currency fluctuation. So I think really that does seem to be the factor that's driving many of these beautiful projects coming up, and beautiful but very, very expensive projects coming up. So I've just finished with the most viewed rental listing, this one in Port Melbourne. Pretty cheap. I don't know if I think it's cheap because I live in Sydney, but $300 a week for that looks pretty amazing. Not sure if it has had much negotiating down, but seems to be a bargain. And then the other property for sale that is attracting a lot of interest is a project in Terranora. So again, potentially people looking for regional locations to get out of capital cities or perhaps work from home. But this is the one for 1.395, what people are looking at the moment. So I'm going to stop sharing my screen and put you onto a survey, and then Candice is going to come back to do some Q&A.
Thanks, Nerida. So I'm sure that there were many takeaways from the data and insights that were just shared with you all. Now we have the Q&A part of the session. So thanks to everyone that sent through their questions at registration. We've had to shortlist and consolidate. However, if there are any other questions that anyone has, you can actually put them into the chat at the bottom of this screen. So Nerida, first question, where do you see, or do you see any difference in impact between the metro and regional markets?
Yeah, I mean, even across metro markets, we're seeing quite a lot of differential. So I mentioned Canberra, obviously still very, very different to other markets. WA is another one that's showing more positive signs. When we go to regional areas, when we have a look at the regional areas that people are looking at, still very high levels of interest in places like Wollongong. So that does seem to be, well, that is the top area at the moment in terms of regional search activity. But beyond that, so places that are they're also doing well are places like Orange. For some reason, Orange just seems to be attracting a lot of first home buyers, a lot of investors. Obviously not a commuter city, but for some reason, it's a lovely city, so I think it's partly driven by that, but that seems to be attracting interest. Then at the luxury end, places like Byron Bay and Berry have come up. And then a couple of unusual ones, Mildura and also Wodonga have been seeing a lot of search activity. So doesn't always make, it's often hard for us to work out what's going on. I mean, we were seeing a lot of mining towns do quite well, which aren't really popping up at the moment, but we are seeing, things like places like Mildura, which is, I guess, primarily farming, and Wodonga, which is probably farming as well, or probably defence. Actually, maybe it's on the back of defence, but those are the areas that we are seeing quite a lot of activity in regional areas.
Okay, great. You did mention a few times that there were some positive signs showing for WA. We've obviously experienced a 4 to 5 year decline. Do you see any further decline for WA at all?
It is one that I don't know how, I do think, like, we do know the mining sector is doing pretty well, relatively well at the moment. So that the iron ore price holding up, and gold, Australia will be the #1 gold producer next year. So, I mean, that's good news. Prior to COVID, we were seeing some really positive signs beginning to emerge in WA, or in Perth particularly, that the rental search was well up. We're seeing there was a lot of positivity in the market. So, I think it will help Perth recover. I think the strength of the mining sector going forward will depend on what happens to the global economy. The fact that mining, though, is holding up, even though China hasn't started their stimulus program, I think is very encouraging. I mean, if we've got, I think it's $100 billion worth of iron ore exports for for the June financial year forecast, and that forecast seems to be pretty much on track. Without that stimulus, I think it does, it is a potential good news story for not just Perth and not just WA, but for the Australian economy.
Great, good to hear. What do you think will be the impact of higher unemployment on the market?
Yeah, I mean, higher unemployment is terrible for property. I mean, if you have a look at what's happened to the rental market, you can see quite clearly that, think from most households, not being able to pay their rent or pay their mortgages is incredibly bad news, and does lead to huge amounts of distress. I think what is different, what seems to be different in this downturn, is that we're not having a financial crisis. So if you have a look at 2007-8, was a global financial crisis. The banking system was in trouble. Go back to the early 90s, it was again a banking crisis. So we haven't got this drying up of finance or these restrictions to finance that we have had in previous downturns. So on one hand, rising unemployment is very bad news. It leads to people getting highly distressed in their financial circumstances. But if you own your own home at the moment and you lose your job, there is a 6-month freeze on mortgage payments available to you. So that does help people hold through, at least for a little while, and prevent them having to sell their properties. So I think I know that the April numbers didn't show much movement in pricing. I do think pricing will get hit, but I do think that stability in the finance sector will make that hit not as bad as it would have been if things were vastly different in terms of people's ability to pay off homes and to be able to access finance.
Okay. So with the impact on owner-occupiers due to COVID-19 and also the weak Australian dollar, do you think we'll see developers shift from an owner-occupier focus back to investment-grade stock?
Not for a while. I think, what we're seeing with investors is that they're not feeling very confident at the moment, and there's a lot of reasons for it. They weren't that confident before that COVID-19 hit, so that hasn't helped. It hadn't really recovered from the Financial Services Royal Commission. I think the 6-month ban on evictions would be putting people off. That if you do buy a rental property and you've got a tenant and you potentially don't have a rental return, that would be problematic. The drop in rental levels, people don't tend to rely on rent return in May. They don't. Sorry, they do rely on rental return, but in terms of the decision making, often the focus is more on capital growth. But that rental return is very important. So if there's a drop in rental levels, that's problematic. And then we've also got that the fact that we're not seeing, or there's not it's unlikely we're going to see strong price growth at least over the next 3 to 6 months. So so I think that's probably also weighing on investors' minds that they won't get a return. On the flip side of that, I guess the fact is that the share market is still very volatile. So if you are looking to park your money somewhere, properties is a good option. And also I guess sort of if you are looking to buy longer term, perhaps the perception that you may get a bargain in this market may also be driving some activity.
Okay. And so with the recent relaxation of restrictions in some states, you did mention that you thought there'd be some structural changes. Do you have any other thoughts around that and whether you'll see a quick economic and property recovery?
I guess that there'll be things like that will take a long time to recover. So overseas tourism will be a big one. And, I think any market or any property type that does rely on overseas tourists will take a lot longer to recover. We've got education is another one that if we can't get those same levels of foreign students back in, whether it's because they decide to stay in their own countries or alternatively just can't get to Australia because of the lockdown and restrictions, I think that could potentially impact apartment markets longer term in places that do rely on university students and lower priced accommodation. So I think for property, they're big ones. I think there's also things that, I think live auctions coming back will lead to a big drop off in online auctions. I don't really think that there are comparable sales type, and so I think we won't really see many online auctions taking place once normal auctions start to come back. But the digital inspections has been an interesting one for us, that we have seen incredible level of interest in digital inspections and video inspections to people. So I think this is, it's really important for the development industry in terms of how much people love that, because developers are one step ahead in that they are often selling something that isn't there. So having a really good digital tool is important, and it's also very popular on site from people wanting to use it.
Okay, thanks for that. So we have a little bit of time to read through some of the questions that are coming through on the Q&A part of the meeting. So first one here, the new development search data is dominated by apartment projects. What does the greenfield search behaviour look like?
Yeah, I mean, it's funny. So the views is dominated by luxury apartments, but the inquiry is dominated by house and land. So, so I think there's a lot of people probably, I mean, we know a lot of people are on our site just having a look around and dreaming. And, so we know that probably is a driver and potentially of people doing that. I think though, what does seem to be happening is, if we look at the inquiry level, what does seem to be inquired on at the moment is house and land, and it also is smaller style apartment projects in very good suburbs. So anything kind of that an owner occupier would want to be in, or anyone who has a lot of money wants to be in, that they tend to be the projects that people are interested in. But those large scale investment type developments that are sort of sold to be rented out, they're the types of projects we're just not seeing many views or much inquiry on at present.
Okay. So how are you finding valuation levels by the bank in assessing house and land package purchases? Land seems to be holding slightly. Build values are often coming in under value.
Yeah, I mean, the banks are interesting at the moment. I mean, we are hearing different things in terms of the way that they're handling certain locations and certain buyers. So, I don't look particularly at land. I mean, I haven't looked at valuation data coming through from banks at all. I mean, we would have that data through Home Track, but I think with the banks, they have been very vocal about being open for business and being prepared to lend and all the rest. But I've got no doubt that I know for sure that they are being very careful about who they lend to and what projects they lend to, what employment types they're lending to, and so I think that's probably what's showing up in some locations where people are struggling to get finance, is that banks are just being very, very cautious in the way that they move ahead, given that there's so much uncertainty out there at the moment.
Mm. And so as an extension of that, with the number of people that have taken up the mortgage holiday, once that rolls off, do you expect a material uplift in direct sales?
Yeah, I mean, this is the thing. I suppose this is the worry with all the stimulus, is that it was given a 6-month time frame. So once it stops, then what happens? I guess in terms of the mortgage payment freezes, it will depend on how many people go into distress and how the banks react to that. And I suppose from a bank's perspective, it is better news to keep, or a better idea if they can, to try and keep people paying off mortgages, even if they give them a little bit of a mortgage payment freeze for a little bit longer, than it is for them having to handle a whole lot of distressed sales and people just unable to pay mortgages. So, that's bad for them from a public relations perspective, people going bust and just having to distress sell. But it is also bad for their balance sheet, and that if they're trying to sell a lot of properties at reduced prices, they may not get the desired outcome that they otherwise would if they tried to keep those loans going. So I think that, we don't exactly know what will happen with those mortgage payment freezes. And I mean, there's so much stimulus that has a 6-month time frame. It's ban on evictions, it's JobKeeper, they've all got this time frame that we don't really know what Australia will look like down the track, 4.5 months down the track, so 5 months down the track. So it's you know, it's a little bit of an unknown at present.
Thanks. Another question here. Do you have any visibility on development site transactions? Are they still happening? Are there any particular areas we're seeing?
Yeah, I mean, we do on real commercial. So they're still happening. We've seen a little bit of a rise in distress. So we do track distressed listings on real commercial, and we use a range of terms to determine that. So it's things like mortgagee, sale, distressed. You know, I think there's 4 or 5 terms that we use when we're tracking that. What seems to be happening, we have seen a pickup in distressed sales for development sites, particularly Melbourne. And when I say pickup, I mean, it's not hundreds. Well, obviously it's not hundreds, but, you know, it's probably 3 or 4, you know, an increase compared to the same time last year. The other area that does seem to be showing a bit of distress, not surprisingly, is retail. So we are seeing a bit of a pickup in shopping centre and retail assets, seeing a rise in distress. But again, you know, I wrote about this, I think, last month, but what it seems to be happening is that right now, you know, we know that there's problems with commercial property and development site sales, but we're not yet seeing people having to get out of the market quickly. But, you know, it may be still to come. So, you know, we just keep monitoring. We're just keeping on monitoring it to see what's happening.
Okay. And are you seeing much crossover between established and off-the-plan property searches, or any significant change in search activity between these 2 markets, to give any insights around buyer sentiment?
Yeah, like it's established property that people are looking at, or the uptick has been in established property. So if you have a look, year on year, established property searches are up 35% or something. And when we look at new apartments, new developments, it's not up to the same. It's up, but it's not up to the same extent. Mm-hmm. The real issue is around inquiry, and that's where we have started to see a bit of an increase in inquiry for established properties, but we're not yet seeing an increase in inquiry for new developments. So, you know, I think it will happen. I guess there's always a lag. You know, there's always a lag. We see these high levels of search, and, you know, we start to see things recover, and, you know, conditions start to get better, but to then switch to sales and to transactions, it does take a little bit longer. I think there's a few things that are helping the established market at the moment. It's not just high levels of, you know, the increasing levels of inquiry and the increasing level of search. It's also that listings have really really dropped down a lot. So, you know, you've got a very strong supply-demand imbalance. That will happen in developer too. That, you know, we know people are unlikely to be able to get new developments up and running very quickly at the moment, particularly if there's no pre-commitments or not much demand. So, you know, eventually what will happen is that there's just not many projects, and there's lots of people wanting to buy. So that will really help conditions. But yeah, at the moment, it's really inquiry that we're missing out on for new development.
Okay, thank you. So we have time for one more question. If anyone else has any they'd like to send through on the Q&A. I do have another one here. Do you foresee a second wave of job losses in the next 6 months as larger organisations start to cycle through the challenging numbers and demand falls?
Yeah, I mean, we're already starting to hear of it. You know, I think obviously the first wave was related directly to the lockdown, that people in hospitality and tourism in particular couldn't work. So if you're working in a restaurant or a cafe, then, you know, there goes your job straight away. We are starting to hear of the next wave, and, you know, this is bad news for some industries. Obviously, anything related to travel, we're starting to see more and more redundancies. Media is an interesting one. Advertising, obviously, people don't advertise. This is one of the things that goes quickly, and so in some the advertising industry was quite reliant on travel, for example. When I had a look at the categories end of last year that were really doing well for the advertising industry, it was travel, and it was in particular cruises. So, you know, that obviously has completely collapsed. You've got a car industry that was already doing it tough, and so they're not advertising. You've got no one's reading magazines anymore. So, you know, people's media consumption is increasing, but the advertising component is where things are pretty tough at the moment.
Okay, lovely. Well, thank you, Nerida. We do have no more questions that have come through, so really appreciate you taking the time to share all of the insights with us. And thank you everyone for joining us. I hope you have a really great day today. Stay safe. Catch you all later next time.